Hello, everybody. This is Professor Hassey. It's our week 7 weekend update video talking about a couple of additional issues and discussions for this week number 7, our next to last week of our corporate finance class. Our topic this week is strategies that drive capital decision making. And up to this point in our class, as we discussed in our lecture video this week, we've looked at the risk management of a company. We've looked at the financial statement review analysis of a company, case 1 and case 4. And we've also looked at the management of a company and picking assets and determining their asset return over time, the present value or the time value of money, and in a particular instance, capital budgeting risk analysis of looking at a specific asset investment and the cash flows and the risk of those cash flows in that decision making. Now we take a look at other alternatives that can drive strategies for companies in week 7 and in week 8. In week 7, we look at mergers and acquisitions, and we are looking at some articles, which I'm going to talk about in just a minute. And those articles will lead our discussions into week 8. We have 2 more grade assessments in this class. We have case number 4, which is a financial statement review in a PowerPoint format, which is due this Sunday, March 20th. Then we have also the electrics case, which kind of sums up the whole course in doing a capital budget analysis, doing the calculations of cost of capital, determining the cash flows, the return analysis, the risk analysis, and then interpreting those results into a format that helps a company make a strategic decision. And also there's other alternatives involved in that strategic decision with market economics of their industry and other factors that I'm looking for in your analysis. And we're going to be discussing these a little bit in our review session this Saturday morning. But our topic at hand this week is looking at strategies that drive capital decision making. And the first strategy is what we summed up in our review on this week in our lecture video is mergers and acquisitions. When companies run out of alternatives as far as getting financing or making a lot of profits, they look for other areas of finding justification for getting capital. And that is in merging or acquiring other companies. And there's a reason for that. It's the operations of their business is not supplying the necessary capital. The financial economies of the industry they're in, or the times. Maybe you're in a pandemic, maybe you're in a boom time and you don't have enough capital to grow. Also, differences in management style, management efficiency. Like it or not, some companies are run very poorly. Some companies are run very well. That management efficiency or that management culture plays a lot into this. And also the changing tax structure. Seems like every 2 to 3 years, the federal government and state governments are changing the tax laws to meet the needs of their users, to meet the needs of the people who support them, and also the changing economic times. As tax laws change, so do the economies and financial responsibilities of corporations. So taxes play a large part in that. And one of the key areas of merging is to make sure it's economically viable. What is the breakup value? What assets are going to be broken up into a merger or dissolved? Or what assets are going to be purchased by the joining of another company? Remember, one of the central themes of corporate finance that we've talked a lot throughout this course is you want to maximize your company value by creating as much return from the assets that you manage as possible. You invest in assets, equipment, buildings, products, territories, divisions, companies to create a return, a maximizing the return so the investors can get paid and you can continually grow the company and stay competitive in your markets. That's the bottom line. And if you cannot do that through the acquisition of debt and equity to provide those assets, you merge or acquire those assets from other institutions. One of the questionable reasons for mergers is, and it's a sticky point, is diversification. One of the reasons why companies merge is to get solid in one particular area of their industry, to become an expert or become viable. But they're also, by merging or acquiring other companies, they're diversifying. They're spreading themselves out into more users, more partners, more managers. That can be sometimes a sticky wicket. Sometimes companies purchase asset at below their replacement cost just to buy the assets. You might buy a technology that's already too late, but you're buying that technology because you think it's going to help your business. But in true fact, the true value of that technology or those assets are below value. That can be a problem. Also, sometimes you acquire the firms to increase your size, thus making it more difficult to acquire. Sometimes companies merge or acquire other companies to make themselves more difficult to be merged or acquired. That's a funny thing, but it's true. Companies want to grow and diversify to make it more difficult, more expensive for other companies to buy them out. That's an interesting part of the strategy behind mergers and acquisitions. Another item that we talked about earlier in the week was the difference between a hostile and a friendly merger. A friendly merger naturally is supported by both managements of the companies and even the stockholders and the creditors of a company. They support the merger because they know that merger will become viable. But also there's times, and many times, there's hostile mergers. When the management that's the target of the acquisition is not for it. The acquisition company wants to take at least 51% control of the company. Just that extra 1% can make all the difference in whether that is a successful venture or not. But sometimes mergers start off as hostile, but then once the companies figure it out and see what it's going to do, it becomes a friendly merger. It's a very tricky thing, mergers and acquisitions. A lot of egos are involved. Egos with company managers and management team, egos with stockholders. A lot of times companies want to be purchased by Apple or Facebook or the major corporations, but then because it adds viability to their investments, they say, geez, Apple owns our business. We must be cool. But after a while, when Apple starts cutting costs and cutting employees and making that merger or acquisition less useful or less viable for those people being taken over, they can find out it's too late. So often there's a lot of different things going on in mergers, both friendly, both hostile, but they also can change during the course of those discussions. And the bottom line to strategic management of mergers and acquisitions is to access new markets, grow your business and technology, become more of an expert. You spread the risk out over multiple divisions or multiple areas of your company by acquiring additional divisions. You can work together and have a general peace in your industry. When you have more power and more control of your assets, then you can work with your competitors or work against your competitors, either way, but try to work in a harmonious environment. The bad thing about this also is it creates flags for antitrust laws. The bigger you get, the greater the antitrust laws to that merger or acquisition. You lessen the competition in your industry, then you're going to start getting the Federal Reserve and the SEC involved, wondering if the competition is to the point where antitrust is occurring. Many times you incorporate a calculation when you're merging, and it's called the true value of the acquisition value, or the present value of what you're getting. You have the cost of capital to acquire a company or to merge with a company. How does that calculate into a valuation model of what the company is going to be worth at the end of the merger? And that's a key point, is if we go ahead and merge with a company or buy a company, how much is our value? How much is the shareholders' value going to increase by this merger? Well, you take a look just like you're doing in case 3 in the electrics case. You're looking at the cash flow that's going to be generated by those assets and seeing how that cash flow is measured to the expense or the cost of your capital to acquire that asset, and is it turned viable? In other words, a positive net present value, a internal rate of return greater than your cost of capital, a profitability index greater, much greater than 1, and a payback in the smallest amount of time as possible to recoup those costs, and then you can reinvest over time if you have a shorter payback. All these things attribute to a successful merger and place in the strategy involved in taking over or merging with another company. There's a couple articles I'd like you to read this weekend or going into next week, our final week of our studies, in addition to closing out case number 4 and your electrics case, is two articles. One is called The Balanced Scorecard, Measures That Drive Performance. One of the key indicators of a company's decision process of investing in an asset, merging, acquiring, coming up with strategies that keep them viable in their industry is, how do you measure that? Well, we've looked, a lot of us have studied in our academic careers, SWOT, strength, weaknesses, opportunity, and threats. That's a standard performance measurement of a decision-making process. But another one that I like is this balanced scorecards. It measures drive performance in a different way. I want you, and a lot of companies are beginning to use this balanced scorecard approach other than SWOT, or both, maybe, to get different perspectives. I'd like you to read this article about of understanding this balanced scorecard, or another way of determining performance of whether a merger, a purchase of an asset, a takeover, an acquisition is viable to the company when you take a look at these various performance measurements of that strategic decision. So I'd like you to read this article. We're going to talk more about it in my lecture video in week 8. And also this approach can be a decent measurement in your interpretation of the electrics case. Another article I would like you to look at is something that a lot of you probably have come in some contact in your own business or management careers: how to implement a new strategy without disrupting your organization. We decide to take over a company. We decide to merge with a company. We decide to invest in new assets to take our business to another part of the world or another state. Is that a strategy that is financially viable, but also at the same time, will it disrupt your organization? Will it disrupt the culture? Will it disrupt the morale of the company? I can't tell you how many times I've been involved with business decision making where they were great business decisions, great financial positive decisions, but they often result in the morale and the culture of the company far exceeded the financial positives of that decision. When you move a company, for example, a few years ago here in Southern California, Toyota and Lexus had their headquarters in Long Beach and South Bay and Orange County. Very successful, doing very well, but they were getting, the management of Toyota and Lexus were getting very edgy about the expense of doing business in California, the pay that they had to pay their employees, the taxes, the environmental laws, all kinds of things. So what they did is they shopped around other parts of the country, and Texas offered them a deal with very little taxes. Texas would pay for their move. Texas would be welcome to bring their operations from California. And Toyota and Lexus went ahead and did that and moved their operations outside of Austin, Texas. Financially, very successful. But half the people in California didn't want to move to Texas. And when they moved to Texas, they found that the employee base and the employee market for jobs was very poor. The quality of labor was poor. And it's taken Toyota and Lexus about 6 to 7 years to work that out. Yes, financially, it was a great move, but it disrupted the organization and morale. And many solid employees did not want to move to Texas for a variety of reasons. And it changed the culture of that particular division of Toyota Motor Corporation. In the long range, it wasn't a great decision because of what it did to this by disrupting the organization. So I want you to read this article. It's very interesting, and some of you might be able to relate to that. Is a strategic decision looking good in NPV and internal rate of return still a good decision about the morale and the culture of your business organization? Another perspective to look at. I don't think you can apply any of this because you need more information in the electrics case, but this is a great article to talk about looking at the after effects or the effects of a strategic decision, not only financially, but other reasons by how it affects your organization. And we'll talk more about this next week. Okay, so those are a couple of things to look forward to and read those two articles either this weekend or early next week. We'll talk more about that in our discussions next week. Also, you can think about how some of that information might apply to your electrics case. This weekend, you're finishing up case number 4, which we talked about in our lecture video this week. It's a PowerPoint financial statement analysis of the company that you have designated throughout this course. And the ones that I have seen thus far are excellent. I'd like the format, and I've given you a sample format, but I'd like you to put your own personal touch on this format, just like you're giving a presentation to a group of individuals about the financial performance of this company. The analysis should be straightforward, but also put in a way that explains it fairly simple of what's the financial situation, looking at 4 different ways of looking at the financial statement of a company and applying that to a PowerPoint in 10 slides about how you interpret that information. I'm anxious to see your work on this. So as you can see, as we head to the last week of class, we've looked at spreadsheets, PowerPoints, writing, presentations, analysis, all telling us about strategies that companies can maximize their shareholder value. And our final work this week will look at other strategies, other decision-making models, other ways of looking at managing our corporate finance or corporate management of our companies. Have a great weekend, everybody. I'll probably see some of you at the review session, and I'm available for any questions this weekend about both case number 4 and the electrics case. Until next week, adios.